Bank of Canada Governor Tiff Macklem indicated policy has likely been restrictive enough to contain inflation. Well, we want to dig deeper into that economic story, and to do so, we're being joined this half hour by two very well-known guests here on BNN Bloomberg. Francis Donald is Global Chief Economist and Strategist at Manulife Investment Management, and Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Thank you both for being here. And happy U.S. Thanksgiving, by the way. Appreciate you being here.
Good afternoon.
Whether there's holidays or not, it doesn't seem like we skew too far from the big story of where the economy goes from here. Francis, why don't you start and give us your assessment of where the economy is right now?
Oh, that seems like a simple question, but I guess you could boil it down to the best is probably behind us. We're going into a year where it doesn't look like there's much of a growth impulse from any area of the economy, and we know that the bulk of the rate hikes, these historically aggressive rate hikes, have yet to be felt by most Canadians. And that may feel like a strange thing to say because we're all struggling under the weight of wage growth that hasn't kept up with the pace of inflation. But we view 2024 as being a more difficult year, and one in which the Bank of Canada will concede it cannot bring down all elements of inflation, and the harm to the economy is not worth higher for longer. So we are expecting rate cuts by the end of the first half of the year. We should probably see the Bank of Canada selectively cutting interest rates as they say it is time to normalize policy. Hopefully that's a good summary of where we're heading.
It's really helpful. A lot to unpack there. Earl, the full effect of interest rate hikes, does that have something to do with the fact that, we keep talking about the mortgage market here and people renewing their mortgages year after year, those shorter duration mortgages, and that sting being felt by Canadians over the foreseeable future?
Yeah, it definitely does. And let's break down the reasons why. Over the next 3 years, there's a significant amount of 5-year mortgage renewals. The mortgages that came about in 2019, 2020, 2021's at the lows. Those payments are going to be significantly higher, assuming no change to the amortization period. So what that means is, and there's a third, higher mortgage payment means you spend less in restaurants, you spend less in stores. That has a negative effect on growth. And so it will be a headwind to further growth.
And I guess, Francis, talking about the inflation story, just to come back to that, the idea of 2% as the inflation target, that's been the goal, the central goal. But it sounds like you're saying we might not quite be there before the Bank of Canada thinks about changing course on interest rates because of that slowdown?
Let me just say I would not want to be a central banker in 2024 in particular. Okay. I think would be a difficult year to be a central banker because all central banks, not just the Canadian Central Bank, are going to see economies that enter recessions or things that look like recessions, but inflation will not be back down to 2%. And that's because we have to face a difficult reality, particularly for central banks, which is that the drivers of inflation are changing. They are becoming less interest rate sensitive. They are driven by things like terrible geopolitical events that are occurring, more frequent and severe weather. Do we have high food prices because we're all eating too much? No, we have high food prices because of a range of supply-driven factors. So central banks, even though they told us for the last 3 years we can and we will bring inflation back down to 2%, are eventually going to have to either directly or indirectly say we can't and we won't bring inflation back down to 2. Now, I don't think we're going to 6, but we could get stuck around 2.5 to 3, and we'll all collectively have to have a lot of conversations about whether or not 2.5 is just fine.
Yeah, well, Earl, coming back to you, I guess on rate decisions, because I think I'm suggesting this correctly, that neither one of you would be surprised to see rate cuts next year. It's just when the Bank of Canada starts to make that transition. Earl, what do you think about how they're going to play this?
I think the number one variable that they will be looking at to decide whether or not they're going to ease is the unemployment rate. If the unemployment rate goes above 6%, they will be more likely to ease. Right now, we're still below 6%. Why is that an important characterization? The reason why we have inflation is excess demand. People are getting paychecks. They're spending it in restaurants and stores. The housing will reduce the excess demand, but unemployment's the key thing in regards to saying once they see that, that's a confirmation that excess demand's going down. They will feel comfortable easing. I don't think it's the first half of 2024, but I can see it late Q3, early Q4, the easing cycle begins in Canada.
Okay, so just to summarize what we've heard so far, let's assume that inflation trends are looking encouraging, but it's still complicated to your earlier point, Francis. Let's assume that at some point the Bank of Canada wants to reverse course a little bit on interest rates, but they're still concerned about the lasting impact of inflation. And then where does the economy land within this? I mean, we have introduced all sorts of terms to describe what kind of economy lies in front of us. What say you?
Oh, every day I go into work and I hear, is it a recession, a soft landing, and a hard landing? We do have negative GDP for several quarters for the Canadian economy, some of which are marginal, like minus 0.2, which effectively makes no real difference for investors. And Canadians are not going to feel differently at plus 0.1 or minus 0.1. That just changes the definition of the environment we're in. But I think the core story is not even does the Bank of Canada cut in April or July. Economists will argue over that, and some of us will raise our hand and say we nailed it, and some of us will not. The core story is that the next move from central banks is likely lower. And for most investors, whether that's 3 months or 6 months, is less important than the idea that we are at peak rates and we have seen peak growth. That is the most important story for 2024. And the headline of the day may shift around it, and it may be a difference of 2 months, but I think the core story is the best and the highest is behind us.
Earl, we get to steal a little of the North American spotlight since they're having Turkey in the U.S. today, so we can talk about our economy. But in the markets, it's hard not to talk about the U.S. economy. It's so influential, but it does feel like, because both of you alluded to our mortgage market, it's different than the U.S. market. Does that change the outlook for the U.S. economy versus the Canadian economy?
Yeah, I think in 2024, people will be talking about the story of divergence. You know, the U.S. is extremely resilient. You know, we are seeing some slowdown in growth, but the growth is just very high Q3 in regards to real growth. Where we're minus 0.1, they're plus 4% real growth. So there's a benefit to that to Canada. What it says, it'll minimize the recession or a contraction that Canada will experience because U.S. is the tide. You know, the reality is U.S. is the tide. If they're doing well, we will benefit from it. So it'll be a story of divergence. U.S. will have better growth, better employment, and you know what? It's arguable they could possibly hike again in the U.S. But we're talking about eases.
Okay, this is